Everyone tells you the same thing about the stock market. Buy low, sell high. Invest in index funds and be patient. It sounds incredibly simple, yet the data shows something completely different. The vast majority of everyday retail investors actively lose money. This failure rate has very little to do with market crashes or bad luck. It happens because our brains are hardwired to do exactly the wrong thing when our savings are on the line. We buy at the peak because we fear missing out, and we sell at the bottom because we panic. The massive financial institutions on the other side of your trades know exactly how human psychology works. They count on that predictable panic. When you look closely at these dynamics, the stock market stops looking like a neutral place to build wealth. It functions as a highly efficient machine, quietly transferring money away from impulsive people and handing it directly to the patient ones. The first gear in this extraction machine is your own emotion. When an asset's price shoots up, the fear of missing out kicks in, driving everyday investors to pour their money in at the absolute highest possible price. Then the cycle reverses. The moment the market dips, that excitement turns into raw fear, pushing those exact same investors to sell everything to stop the bleeding. Every time an investor clicks sell during a market drop, a large institution is waiting on the other side to buy those shares at a steep discount. Checking a portfolio during a crash and giving in to the urge to sell has cost everyday people more money than historical market crashes themselves. By relying on our predictable reactions, the system consistently buys cheap and sells high at the public's expense. If your emotions don't drain your account, the fine print will. You encounter expense ratios, brokerage fees, currency conversion charges, and taxes on short-term gains. Individually, these look like rounding errors of 1 or 2%. This animated chart illustrates investing 10,000 rupees monthly for 20 years at a 12% return. Without fees, compounding builds a massive corpus. But apply a 2% annual fee and you lose compounding growth. Over 2 decades, the gap widens aggressively. By year 20, that tiny fee eradicates 40% of potential returns. Hundreds of thousands vanish. Many investors look at their disappointing balances and blame a bad stock pick, unaware that the invisible mathematical drain built into the system is what actually hollowed out their portfolio. Even if you master your emotions and avoid high fees, you are still operating at a massive speed disadvantage. Institutional investors have access to expensive data feeds, proprietary algorithms, and deep insider research that the public never sees. By the time a positive news alert hits your phone, hedge funds have already processed that data and executed their trades hours earlier. The game operates exactly as designed, rewarding whoever owns the physical infrastructure to acquire and process information first. As long as speed dictates market success, the average retail investor tapping on a mobile trading app will always arrive late to the table. Escaping this extraction process requires an entirely different approach to how you handle your money. It starts by ignoring the heavily marketed appeal of leverage and options trading, the exact tools that often wipe out years of gains in a matter of days. This diagram illustrates dollar cost averaging, investing a fixed amount on a regular schedule, completely ignoring whether the market price is up or down. Because you buy automatically, you stop guessing tomorrow's prices. The anxiety disappears, and human emotion is removed entirely. While losing traders frantically chase headlines and react to every red candle on a chart, the investors who win in the long term are the ones willing to do absolutely nothing for years on end. Holding broad index funds over decades is mathematically the only strategy proven to work across every crash, recovery, and bubble in market history. Financial security is rarely built through excitement. It is built through a rigid, deeply boring discipline that the vast majority of participants lack the patience to endure.